The price-to-earnings ratio, or PE ratio, is a financial metric used to evaluate a company's stock price relative to its earnings. It's a popular tool for investors to determine whether a stock is overvalued, undervalued, or fairly priced. The PE ratio is calculated using the formula PE ratio equals price per share / earnings per share, EPS. For example, if a company's stock is trading at $50 per share and its EPS is $5, the PE ratio would be 10. This means investors are willing to pay $10 for every $1 of the company's earnings. There are two types of PE ratios, trailing PE and forward PE. The trailing PE uses the company's actual earnings from the past 12 months, providing a snapshot of current performance. Forward PE, on the other hand, uses estimated future earnings, helping investors evaluate growth potential. For instance, a company with strong future earnings expectations might have a high forward PE, signaling optimism about its prospects. The PE ratio is often used to compare companies within the same industry. A higher PE indicates that investors expect higher growth in the future, while a lower PE might suggest the stock is undervalued or the company has lower growth prospects. For example, a tech company with a PE of 30 might reflect investor confidence in its innovation and future profitability, while a utility company with a PE of 10 might indicate steady but slower growth. However, the PE ratio isn't perfect. A high PE doesn't always mean a stock is overpriced. It could indicate strong future growth potential. Similarly, a low PE doesn't necessarily mean a stock is undervalued. It might signal underlying issues, like declining revenues or increased competition. The ratio also varies by industry. Growth-oriented industries like technology or biotech often have higher PE ratios because of their potential for rapid expansion, while mature sectors like utilities or consumer staples typically have lower PE ratios due to stable but slower growth. Investors often combine the PE ratio with other metrics to get a clearer picture. For instance, comparing the PE ratio to the industry average or looking at the price-to-earnings growth, PEG ratio, which factors in earnings growth, can provide more insight into a stock's valuation. In summary, the PE ratio is a simple yet powerful tool for evaluating a company's stock price relative to its earnings. It helps investors understand market expectations and make comparisons within industries. While it's a valuable starting point, it should be used alongside other financial metrics for a more comprehensive investment analysis.